Welcome everyone to the Asia Risk 25th Anniversary Week. This week we will be hosting a full week of forward-looking webinars covering major themes like investment, LIBOR transition, technology's role in the current environment, regional countries and responses to the pandemic, and last but not least, next generation risk management and strategies. Besides the insightful panel discussions, each day we will also be announcing some of our award winners and featuring some winner interviews, which highlight the innovation and effective strategies our winners managed to showcase this year. Starting off today, we will be focusing on the frontier and potentials of investment and what the future holds. With me today is our Bureau Chief Asia from Risk.net, Blake Evans-Pritchard. Hi, Blake.
Hi, Steve. Very good to be here.
Thank you so much for joining us. Blake, busy week ahead, as I mentioned, with lots of award winners to be announced. I know our audience would be interested in hearing you walk us through the editorial team's judging process. Just how does it work?
Well, it's been a very intense month and a half, us on the editorial team, myself and my colleagues, going through all the dozens and dozens of pitch documents that we received and working out the sort of core group of participants for each award that we should shortlist and go out and meet, or in this case, many of the meetings were done remotely. And then we spend an hour or sometimes even longer going through in detail their submission and the value they bring to the market and the sort of structured solutions that they've come up with. And then we go to some of their clients and speak to them as well and get some client feedback is an important part of this process. And from that, we can reach a decision.
A challenging process, no doubt. Extremely interesting, though. And could you tell us some of the key trends you've been observing through the process?
Well, obviously, it's been a fascinating time to be running the awards this year. Perhaps one of the sort of most interesting market environments that I've actually personally been doing this in. So it was really interesting to see the fallout, which is still going on from the sort of COVID crisis. When you look at the sort of volatility in the market and how that's impacted structured products, which is a significant business in many markets over here. And you just look what's happened in Korea and sort of all the losses that some of the sort of structured products, auto-callable products have come about because of them. And so it's been fascinating to see how banks have adapted, innovated, continued to innovate and responded to their client needs in the way that they have.
Well, thanks so much for sharing that, Blake. We'll see you this week. Stay tuned, everybody. If you're like me, you're looking forward to the panel discussion, award winner announcements, and some interviews with a selection of winners afterwards. On with the show. Derivatives House of the Year, Asia x Japan. UBS. RMB House of the Year, Crédit Agricole. Interest Rate Derivatives House of the Year, Goldman Sachs. Credit Derivatives House of the Year, Credit Suisse. Equity Derivatives House of the Year, Credit Suisse. Currency Derivatives House of the Year, Standard Chartered. Asia Structured Products House of the Year, Goldman Sachs.
Hello, and welcome to today's panel discussion on the major investment trends to look out for in the next 10 years. My name is Blake Evans-Pritchard, and I'm the Asian Bureau Chief for Risk.net. With me, I have a group of industry experts that are able to provide informed insight into what these investment trends might be. Chi Kit Chai is Head of Capital Markets and Chief Investment Officer for Ping An Asset Management. Benjamin Deng is Group Chief Investment Officer for CPIC. Jesse Liu is Chief Investment Officer, ASEAN Fixed Income for Principal Asset Management Berhad. So the COVID-19 pandemic is driving massive changes in the market. Markets are now awash with central bank liquidity, which is arguably distorting asset prices, whilst at the same time interest rates remain near historically low levels. This is bound to factor into firms' asset investment strategies. So let's turn to our panelists and see what they think of current trends. So Benjamin, maybe turn to you first. What do you see as the sort of current macroeconomic investment trends that are shaping the market?
Well, the macroeconomic trend we've seen after the COVID-19 pandemic, or in the middle of it, there are two or three main themes. Number one, ultra low yields on the fixed income side, and we've seen U.S. yield going down to to a level we've never seen before. European market has been even a negative yield space for quite some time, even before the pandemic. And China, also we've seen the yields coming from the end of last year to a very low level, which we have not seen in many years. By the mid of second quarter, then it came back again. So although in China the yield have come back to a level that possibly at par with late last year, still we think the yield is going to go low and stay lower in a gradual way, and stay low for a long time. So that low yield environment around the globe will be like this for quite some period as far as we can see. So that's one big theme. The other one is with central bank printing the money and the quantitative easing, we are seeing the liquidity being pumped into stock market. So stock are going up, and that happens in China, that happened in the US. Well, in the US, we've been hearing people saying, we're in a bubble, we're in a bubble. Yes, we've seen the bubble, but so far the bubble still is getting bigger, if there is a bubble indeed. So that's a second thing. A third thing, I think a trendy thing, as far as I can see at this part of the world in China, is private equity. And with a lot of new technologies, being medical science, being artificial intelligence, algorithmic trading technologies, or big data analytical technologies, these companies are gaining popularity. And when we talk about the stock bubbles, a lot of these things are related to these unicorn companies, these new technologies. We don't know how far they can reach and how widely they can reach, but at least for now, these companies are gaining popularity and are gaining attention. And with this, I'm in the insurance industry. So to support the insurance industry, we need technologies. We're using new technologies to screen customers, screen the risks, to help setting claims, everything. So we're investing in these things as well. Medical services, medical equipment. So yeah, private equity has a great future, has a great growth potential in China. That's somewhere we're putting a lot of attention and efforts into. I'll just briefly stop here and leave it to other panelists. Thank you.
Thanks for those introductory thoughts. So, Chi-Kit, maybe I'll turn to you next. I mean, are you seeing similar themes from your side?
Yeah, right. Yeah, we are seeing similar themes, but I would just talk about it from a different perspective, right? So, I mean, I agree with Benjamin that there are certain key themes actually have been happening in the market or from a macro perspective. Like for example, that we are seeing, like for example, the assets shifting from traditional asset classes to public equity or public markets, right? So this is actually a theme that we have been seeing for about a decade already, but it's still going on very strongly. and we have been talking about the active versus passive for a long time already. And the debate, I mean, obviously that passive have been gaining market share, but the debate has not ended, right? So this is another key theme that we are seeing, and then it's worth exploring again, right? And the rise of ESG and is another one that we are actively pursuing. I think that is because that is important to do well and do good at the same time. But also at the same time, I want to talk about that macro trends or trends, actually, they are driven by forces, right? So the forces that we are seeing, number one is the macro or market environment. Number two is technology, right? So Benjamin just talked about the ultra low interest rate environment that we're experiencing that too, right? So because we're asset owners, we are asset managers, we're trying to look for yield, we're trying to look for return, and in a zero interest rate environment, it's very difficult. And not only that, we're also seeing economic uncertainty, right? So what that means is actually we are entering, or we have already entered, a low return environment, and volatility and correlation are set to rise. So this makes asset management very difficult, right? So let's think about it from a fixed income standpoint. For a long time, since the beginning of fixed income, bonds actually have been acting as a diversifier, right? So you diversify your risk. And also at the same time that it produces income, it generates income for your investment. So when you have a situation that interest rate or yield is close to zero, so that diversification effect is basically gone, right? So because that your upside is limited, but your downside can be significant as interest rate normalizes, right? And also at the same time that you do not have that income, so your return in general is lower. And also when risk-free rate is low, you can expect other asset classes to be lower in terms of returns too, right? So these are all very difficult environment for asset management. So I'm going to stop here, and Jesse might have something to add.
Yeah, absolutely. Yeah, thanks. An interesting point. So Jesse, from your side, asset managers are having a bit of a tough time at the moment.
Yeah, it's true. What my colleagues have mentioned. I think at this particular point, the returns, I mean, in the foreseeable future, I would presume that everyone will be looking at the ultra low yield environment, and they will plan their portfolios accordingly. But if I were to provide some perspective in terms of the clients that I engage with, basically on my side, I deal with both corporate, institution, and also retail clients. And we do see different trends coming from both of them, these different groups. And these trends are particularly different. So when we have institutional clients, which are largely more sophisticated, you would see that they would be looking for other alternatives to enhance their portfolio, in the sense that they would move into other kind of fixed income product, so to speak, in the other markets. And these products would tend to, I believe why they go into these kind of products is that in their portfolio allocation, they would still value low vol kind of positioning, so to anchor the stability of their portfolio. At the same time, if we look into the retail space, you would see that the retail investors may not have the reach that the corporate and institution clients that might have. And so the retail guys, typically their options will still be pretty much bonds. But so in this kind of environment, although yields are low, there are still the retail clients who want to position some of their portfolios into bonds. But the bigger question is that which bonds, right? So I do see in different markets, for example, markets like Indonesia, where yields or rates are still relatively high, retail would still position in there. At the same time, even in Malaysia, where I'm based at, we have clients that is still positioning into bonds, even though we are at 1.75 in terms of our policy rate over here, down from 3%. So in that sense, even though there is a decline in interest rates, that appreciation for volatility somehow is still there in investors' mind. I think largely because macroeconomic trends doesn't seem to be all that clear for them. And there is some form of worry in terms of where global economy will be in the foreseeable future. So that's why they would still have some position into low volatility instruments like bonds or alternative fixed income products.
Sure. Okay. So no, thanks for all of your thoughts on that. And obviously we're kind of like a bit in the eye of the storm at the moment. We're in this kind of like low yield environment. We're seeing some of these sort of macro trends that we've talked about emerge. I was quite sort of like to sort of throw out predictions and see what imagine what the world might look like in the next 10 years. So I'm sort of going to ask each of you to give some kind of like sort of predictions, about what the next 10 years might look like. And predictions are often interesting things because they're often wrong, but can be based on sound understanding the markets at the moment. So Benjamin, maybe I'll turn to you first on that. Well, what do you think the next 10 years will hold?
It's really hard to predict next 3 months, so I'm gonna try to predict for next 10 years. But one thing we're sure about in the next 10 years, aging is going to be a common phenomenon globally. I'm an insurance guy, so paying attention to demographic changes is a part of my job. And with this, we shall see that consumption patterns are different than what we had before. And then we logically will think how people are ready for their retirements. So if they are ready for their retirements, they would need stable income assets. As a traditional CFA charter holder, we would think a person at 65, 70 years old with enough savings, he or she is going to have most of his or her income savings into the bonds. But now we're seeing this uncertainty around the world. So, and also the life expectancies are getting longer. And people are living, it's very common we see people living to 90 years old, 100 years old. And so what I'm thinking is equity market still has a good one. And bond market will stay low. The yields will stay low. Yeah, and the real estate is going to have a tough time because a couple of things, just from residential real estate. When people are in the next 10 years, people are getting old. We don't need, I will be retired. I don't need a big housing. And a lot of people at the same age would be in the same situation. In China, there's just too much supply of housing. The residential housing were built abundantly years ago. So that's on the residential real estate. Commercial real estate has a big turn since the pandemic. So we think a lot of companies are considering cutting their space because they realized we can work remotely, having people taking shifts, and then cutting the new technology will help prompt the facilitate the business communication. So that's what I'm thinking about. Commercial real estate will have a really tough time in the next 10 years. And so I think new technology, environmental protection, clean energy, and food, the need for clean food, healthy food will be strong, the need for medicine. And so in the next 10 years, we're going to see a shift from the traditional demand for housing, for properties, into these equity type of things. That's what I'm thinking. And another big thing is something I will put up there. I don't have an answer. I have my own opinion is about the demand for gold. So are we going to shift back to gold standard or quasi gold standard? There's a big debate about this. And how will the global currency system behave or perform in the next 10, 20, 30 years? I think there's a big question mark. So I'll stop here. Yeah, thank you.
Sure. Okay, thanks. And just maybe a quick follow-up question on some of the sort of trends you were raising there. So obviously you're coming at things from sort of an insurance perspective, but being in the insurance company. So I mean, how is that going to affect some of the things that insurance companies would look at in terms of like their investment strategies and what they're investing in to meet their long-term liability needs?
Absolutely. So private equity, I mentioned before, that's one asset class that will have a long, I don't call it mathematically, it's not duration, but really it's a long duration in terms of investment horizon, and large growth potentially if we can have the right assets in the portfolio, and investing in elderly caring business, health protection. Those are the big themes today. So new technology, new medicines like vaccine for this, pandemic, this coronavirus, and screening, health screening, looking at, just remotely, we look at people just to check the face, check the color of the and the pulse and the palms, everything. You can have a diagnosis of the health situation remotely. These are all things we're deeply looking into.
Sure.
Yeah.
Okay. And okay, thanks. And Chike, maybe I can come to you now for your 10-year prediction.
That there was the movie Back to the Future, and about 30 years ago, and they predicted a lot of things that actually most of it happened. Really, long term. Predicting term is very difficult. If you look at the trends, I think that there are certain trends that are entrenched, and then we can bet on it that things are likely to happen, right? So the way that how I see it is, number one is technology, right? So I'm talking from an asset management standpoint, investment standpoint. Investment actually have been a laggard in terms of adopting or utilizing technology. So I think that we are going to use, the whole industry going to use technology to boost returns, manage risk better, make better business decisions, right? So and to be able to reach clients like distribution or have a better customers experience, right? So all these things actually are enabled by technology, right? So there's the democratization of investment, because that now with technology, used to be that the investment is actually concentrated in the hands of experts, right? So now people actually can do investment themselves, but they still need professional help, right? So how do we help the clients or customers when they're empowered by the knowledge and by the technology, right? So how do we use technology ourselves? How do we enhance performance? How do we manage risk better? all these things. So it's actually, I think this is going to be a pretty tough transition, because technology is I would say that is difficult for investment management industry, right? So we have been lagging in terms of using technology, although that we are seeing a pickup in terms of machine learning, right? So we are using a lot of machine learning to manage our investment strategy. We're using technology to, let's say, to train our salespeople, right? We are using AI to manage risk. We are using AI to do better forecasting, right? All these things are actually happening right now. And I think that another thing that I see is because of the uncertain economic environment, right? So beta become very uncertain and lower, right? So we are expecting lower return from beta and more volatile beta. So we have to be putting more emphasis on alpha, right? How do we actually generate alpha? And alpha is very different. A lot of people say, excess return is alpha. Excess return are not alpha, right? So your return over benchmark is not alpha, right? Alpha, the proper definition of alpha is actually uncorrelated stream of returns. So they have to be uncorrelated. how do we find uncorrelated returns? So this is not difficult. Beta is cheap to replicate. Alpha is difficult. It's a zero-sum game. If I take from you, you have negative alpha.
Sure. Okay, thanks. And I guess the point on alpha, I guess it's also a question of how you can sort of generate that alpha in a cost-effective way as well. So you're not having to charge large amounts of fee.
Just like when I talk about technology also helps to control your cost. It used to be that you might have to hire very expensive portfolio managers to generate alpha, but we can actually have an algorithm using deep learning or neural network, and then to generate alpha, and then we can scale up, right? Because we own the IP, right? So if the portfolio, a lot of times that when we actually, as an asset manager, we are very worried about if the portfolio manager leave, what will happen to the portfolio? What will happen to the strategy? But we have a process, we have a technology, right? Even the people leave, we can actually maintain the same process and produce the alpha.
Sure. Okay. I mean, the technology part is obviously very interesting. So I'll come back to that in a minute, actually. But you just want to go to Jesse to get your thoughts on what you think we're going to see in the next 10 years.
Well, I think from my side as a portfolio manager for fixed income, like what Benjamin mentioned, it is pretty much different to forecast, next 3 months, let alone 10 years. But the one thing that we do try to look into or try to understand more is really monetary trends, and we kind of come to the expectation that for the next 10 years, global rates would continue to decline further, right? But this phenomenon is not something that is new. This phenomenon has started back in '85, and we are at this point right now whereby when all global rates are zero, there has to be some other changes to the global structure, economic structure scene, largely because we are pretty much at its end in terms of what governments or policymakers do have in their toolkit to weather another downturn. So it is so if I were to look into the next 10 years, I would probably say that immediately in the first few years, you will see rates continue to be low. But in the event, if we have another downturn, chances are we may come into a point whereby you need a different kind of approach, whereby there should be structural changes to the global economy, something to the effect or to the degree like probably the creation of fiat money, for example, something to that tune. So in that sense, I think what is important for us to note is that as portfolio managers, we know that the trend is staying here as it is, it's declining. Every interest rates are going lower and lower. But the point is that if we are up to a level whereby these policies no longer can carry the effective weight to counter a downturn, what needs to change? So I think we need to look, for the first few years, we probably can still look at monetary and fiscal policy, but moving down there, we need to look into other parts of the government's policy toolkit. So immediately, if I would talk about the next 10 years, the cheapest way or immediately in the next 1-2 years, the cheapest way to change global macroeconomic scene is really trade policy. So trade policy will be something that it is beneficial for everyone. It will probably give a lot of government a lot of leeway to increase global growth without spending a lot of money in that sense. So I would expect a lot more different kind of policies that will be affecting us rather than just monetary and fiscal policy moving down the road.
Sure. Okay. But I guess just quick follow up on that. I mean, I guess that's that becomes quite uncertain as to what more the what more the governments can do when they kind of like run out of ammunition in terms of of rates and things like that. So what structural change they can actually do, and I guess, and to what extent, I mean, you know, do you as an asset manager have to think about that or sort of speculate, you know, what structural shift there may be? Is that something you'll eventually start watching?
Yeah, we are really. So the immediate policies that we think that are low-hanging fruits will be foreign policy, trade policy. Those will be the easy ones. So the worry would be if we continue to see stress in trade policy and foreign policy, you probably won't see these interest rates move anywhere from where it is today. It probably will stay low or go negative. But if there are changes, if there are structural changes in this policy, it's not only in terms of global trade or global political scene, even in the US alone, structural changes are very powerful in the US to carry the whole world. So we are looking actually for those patterns and reacting to them. The funny thing with all these policies is that these are devised and developed by human beings. So a lot of these things really are something that we need to try to understand more through understanding the people that is in charge, people who are making these policy calls. So it's very important for us to understand where they are coming from in terms of their view of how to bring their country or how they negotiate with other countries, their relationship, their trade relationship moving forward. So those are the things that we look at. So the troubling thing for us really is that this scope is really wide and it can be anything, right? So, but the important thing is that there are some things that we can plan for, like what CK mentioned earlier. There are things that in principle, asset management, we can have a robot really to help us to do it. So that is really powerful for us on the quantitative side. So on the qualitative side, when we supplement it into our asset allocation, that's where it comes in, where we can tweak our portfolio to account for all this kind of qualitative decision-making that can happen globally and how it affects our portfolio and how we want to position our portfolio after considering quantitative and qualitative factors.
Sure. Okay. And just with the time that we've got left for this discussion, I just want to sort of dive a bit further into the sort of technology aspect, because I mean that's been mentioned by all of you. You know, the importance of technology in terms of, I think Chikit was mentioning it in terms of alpha, but also being more efficient in the way that you're generating returns and things like that. So maybe I'll go back to Chikit first on this, because I mean you did talk a bit about technology, and I know you've been doing some sort of interesting stuff with AI and investment in China. I'm just wondering, you know, how well understood is technology within the sort of asset management sector in terms of, you know, how it should be used. I mean, how much, you know, I mean, what areas are going to be interesting going forward? Is there still quite a lot of sort of exploration going on as to the best way that technology should be? Are we just kind of like at the beginning of the curve?
Right. So, first of all, the way that how I think about technology is, to use American football way of saying it, that we need to play offense and defense at the same time, right? So from a offense standpoint, generating alpha, right? So you need to, we don't generate alpha, then we don't have the reason to exist. And we need to improve customer experience. We need to be able to distribute our product, right? So from a defense standpoint, how do we actually lower cost, make better risk management decision, right? So these are all can be done with machine learning. I mean, I understand that a lot of people talk about deep learning, neural network, machine learning, all this stuff. I mean, so this is not new, honestly. I mean, this actually have been around for many, many years. And only recently, because of their computing power, have been advanced so much. And also some of the newer techniques that like Google actually have brought to the world, like using TensorFlow, things like that. So we have been able to write algorithm, particularly that we can actually do models that are non-linear, right? So because I've been talking about this for a long time already. So linear modeling have been around for a long time already. So this is the first generation of what quantitative investment actually been doing using linear modeling. So we are in the second stage, non-linear modeling, because of the advancement of computing power and also machine learning, right? So this is one part of it. But the second part of it is actually, I think that it's very difficult to use technology, because most of the executives in the investment industry, they don't come from technology background. They come from investment background, right? So and then how do you have the mindset, the leadership, the culture, and the talents? How do you manage a whole new thing, right? So because the world is going to be changing because of technology. The trend is happening no matter whether you like it or not, right? So you have to catch up. And this is actually, I would say, the most important part is actually how the firm actually invests in technology strategically, right? So because there's so many, right? So from operation to investment to risk management, and then you have to find, because you cannot be good at everything. Hopefully, there's some part of the chain, value add chain, that you can do something better than other people, right? So this is actually one way that executives should think about how they use technology strategically and holistically, and combine everything together, so you won't be lagging behind.
Sure. Okay. And Benjamin, in the insurance sector, you know, how do you feel technology is going to change the insurance sector?
So look at this way: if we have an elderly caring facility, we're looking into using robots to service people. And just my personal experience, I was in quarantine for 4 times. Okay, so on the 3rd time, I was in a hotel in Shanghai, and when I ordered things, whether it's food takeout or I ordered some groceries, things were delivered to me by a robot. That was a very refreshing experience. Because a robot would call out, my phone would ring in the room. I open the door, there's a really cute robot in front of me. And I open the door, I got my things out. And so that's only a tiny bit of personal experience. We are looking into how to service our elderly customers in a more efficient and very interactive way. Interactive meaning the robots can communicate with people and even talking like a chatting partner. This kind of thing. And how to improve sales efficiency. Not only just everyone has a pad, right? On the pad, we can automate a lot of things and make products almost like going in front of you, in your face, very in a very efficient and quick way. Immediately, you see the features and you see the sales, the pitch things, the pitch book. Everything is automated. So that's about just there are many types of technologies, but what we're emphasizing on is the efficiency and effectiveness. As I was talking to one of the major investors in our company, I said, okay, what about we invest in these technologies? They go, yeah, there are tons of investments into technologies. My question is, how effective and efficient are they? If you invest in technology, I want to see results. And not just about some propaganda kind of thing, company show off. We've invested in Alibaba or something different, or Ant Finance, but we want to see the financial results. That's something we pay a lot of attention to. Yeah, thank you.
Okay, thanks. And Jesse, finally to you. I mean, how important is technology for your company?
Yeah, it's very important. So as we are experiencing this low yield environment everywhere, generally producing returns for our clients will probably be a more challenging task moving forward. So chances are margins for asset management would probably be compressed. And so every single department in my company would have to think of adoption of technology to make themselves more efficient, so to speak. So specifically for investments, I think what is very important for us to highlight is that we always try to encourage our personnel to embrace technology, and we try to use an interesting analogy to do it. So because we do have staff that has been with us for a long time, so obviously there are those who are very cautious about technology replacing them as a person in the company. So what the message that we send to our staff is this, is that if you were to watch a movie, let me give you 2 movies for you to imagine what technology. What we say to them is that you watch the movie Terminator. We are not trying to build the Terminator. You watch the movie Iron Man. We are trying to build Iron Man, and you are inside Iron Man. So that's what we tell our staff. And we told them the way they look at technology is different. So when we start to build our valuation model for our staff and told them that, you don't have to do it the old way right now because this guy is going to do it for you. So then they would come back and give a feedback to us and say, hey, that is really a good idea. Now I have a lot more time to do other stuff in my job. And they would bounce out here and say, there are some stuff that we can do in credit research whereby, we can input this kind of a methodology or this kind of a module inside to our computer system, and probably we can save more time. And at the end of the day, where we are trying to aim at is that, can we make our staff so efficient to the point whereby we can increase the amount of AUM under management without increased headcount? And I believe we have done so for principal asset management. And that is what we are trying to embracing. But the first thing, I agree that what we need to do is to start from the culture where we work in, because there will be people, like what CK rightly pointed out, there will be people that may not know technology, and they will be afraid to embrace technology because, given their age, they are close to retirement, so on and so forth. They might not even want to embrace technology. So if you want to drive them to embrace technology, you have to give them an analogy of how technology can embrace them differently and help them.
Sure. Okay. So we're sort of drawing close to the end of this discussion. So it's been fascinating to hear everyone's views and predictions on what the asset management world will look like going forwards. So I thought a nice way of ending the discussion would just be to ask each of you to give one word that would encapsulate the trends that are going to be seen in the investment landscape over the next 10 years. So obviously it's sort of a challenging thing to come up with a single word, but Chi-Kit, so maybe I can turn to you first.
Okay, I'm just afraid that everybody has the same word. So I'm going to use the word change, right? So I think that things are changing, right? So, but I mean, it's not just change, but also the speed of change, the second derivative, right? So the rate of change also accelerating. So I think that we are seeing change, and we are seeing accelerating change.
Okay, and Jesse, what would your word be?
Mine, well, I have a few words, so I was thinking which one to pick, but mine is more towards, I think this world needs a lot more tolerance for the next 10 years. It is not a trend that I see, but I think it would do a lot of good if we do have a lot more tolerance in the whole world. Largely because there is a lot of stress right now everywhere, and these stresses are not only impacting the way we work over in the financial industry, but also impacting lives across the world in so many different ways, ESG way, political ways, so on and so forth. So I think the major thing that I would really want to see is really tolerance for the whole world to happen.
Okay, thanks. And Benjamin?
I was thinking about change, but then I'm going to choose a different word. Cool. Just be cool. The world is changing, and we're all changing, but rest assured, we're not the first generation that is changing. The world has been changing for 5,000, 6,000 years. Just the difference is a matter of the speed. And be cool, stick to the principles, stick to the fundamentals. I think we're gonna ride through a lot of the volatilities and turbulence just fine.
And just roll with it. Yeah. Okay. Well, thanks everyone. Thanks to our our panelists, Chi-Kit Chai, Benjamin Deng, and Jessie Liu, and to all of you for listening. It's a very interesting panel discussion, and we will have the winners of some of the awards announced shortly. So please do stay tuned.
Asset Management Firm of the Year. Ping An Asset Management. ETF Provider of the Year. Uanta Securities Investment Trust Company. ESG Provider of the Year. Société Générale. Deal of the Year. Deutsche Bank. Private Bank of the Year. Credit Suisse. Index Provider of the Year, MSCI.
Today with the winner of this year's Credit Derivatives House of the Year, Credit Suisse. Joining me is Joo-Ho Lee, Head of Solutions Structuring, APAC Trading Solutions, Sumitra Bhattacharya, Head of APAC Structured Credit Trading, and Jackie Zhang, Solutions Structuring. Joo-Ho, as the winner of the Credit Derivatives House of the Year award, what is Credit Suisse's winning formula?
Well, Credit Suisse is a market leader in many areas: credit origination from the banking relationships, distribution through private banking franchise, and structuring capabilities on the trading solution side. These enable us to identify the right borrowers and investors and provide the high-quality solutions to satisfy both. However, the real winning formula is the culture of collaboration, which lets people of different expertise work together, bring innovations to the table, and create value for the clients. Credit Suisse has many institutional frameworks to minimize conflicts and maximize incentives for collaboration, which obviously helps, but the key strength is a cultural element, I think.
Thank you, Joo-Ho. How does Credit Suisse have plans on capturing the Asian credit derivatives markets under these challenging times?
We see three key aspects where Credit Suisse excels. Number one is the collaboration across various divisions at CS. Clients often have complex challenges. Solutions to these challenges often need to span across a variety of products and teams. CS's differentiation is in being able to provide seamless solutions that involve multiple teams collaborating to deliver the best products and ideas to our clients. Number two is the speed of delivery. Market opportunities can be very short-lived, and in many cases, timing is everything. At CS, we have time and again demonstrated our ability to bring products to market very quickly. This wouldn't be possible without fantastic internal teams across legal, risk management, operations, finance, quant strats, and so on, all of who work together with the desk to meet very tight deadlines, enabling us to deliver for our clients. And last but not the least is sophisticated risk management. The best players in the structured credit business are the ones that are very good at breaking down complex risk or payoffs into a series of manageable risk components. CS excels in finding innovative ways to manage risk from various transactions, and in the process creates interesting products for our institutional and private bank clients to take risk at attractive levels compared to what they can get in the vanilla credit markets. It's a win-win for everyone.
I think many factors and dynamics create market dislocation in various areas of the credit market. Credit Suisse is uniquely positioned to capture these relative value opportunities and pricing dislocations by delivering the full force of the bank. So our value lies in bringing together all the various divisions internally, as well as various market participants, coupled with our innovative structuring and risk management expertise to deliver high value-added solutions. So we definitely owe our success to our partners, including, in particular, our investment banking team, who are absolutely the best in class, as well as our powerful private banking franchise, together with whom we've built an unrivaled platform in this space. We're also very grateful to our clients for their trust and partnership, who look to Credit Suisse to deliver what are some of the most innovative solutions in the markets today.
What are some of the main themes shaping the Asian credit derivatives markets in the current environment?
I think there are two contrasting themes at this moment. I think number one is the low interest rate environment that we are in, and this probably is the biggest driver for the Asian credit market this year. The low rates coupled with a relatively benign issuance calendar so far has meant a huge rally in credit spreads, especially post the wides that we saw in March and April. On the flip side, though, the financing costs for clients have also reduced significantly, creating some very interesting leverage return opportunities in quality credits. The other trend, and quite in contrast with the first one, is that there has been a spike in the number of debt defaults this year. So even as the broader market continues to rally, we're seeing a lot of credit defaults, and therefore now more than ever, our ability to pick quality credits and risk manage our trades has become critical.
So I think we have weathered this year's market turbulence exceptionally well, putting Credit Suisse in a strong position to provide liquidity where others have retracted and alternative solutions to our clients, even during periods of market stress. Credit markets are always evolving. There's definitely much more we can do, and there are many more innovative structures and ideas that are in our pipeline currently.
Thank you, Jackie, Sumitra, and Juho. And once again, congratulations for getting the award.
Thank you, Marcel and Asia Risk for this honor. We are really pleased to receive this award.
I'm excited to be here today with this year's winner of the Equity Derivatives House of the Year, Credit Suisse. Joining me is Min Park, Head of Solution Sales for Asia Pacific, and Stefan Goursat, Head of Investment Solution Sales, Asia Pacific ex-Japan. Hi, Min. As the winner of this year's Equity Derivatives House of the Year, can you tell us what is Credit Suisse's winning formula?
Okay, first of all, thanks a lot to Asia Risk. Credit Suisse is extremely proud to receive the grand total of 4 prestigious awards this year, in particular, Equity Derivatives House of the Year award. This accolade underscores our long-standing market leadership in equity derivatives and the strength of our valued client relationships. This year's win is especially significant to us in the backdrop of COVID-19 pandemic, as it's a strong testimony of our clients' trust in us, especially during the volatile and uncertain markets. Our track record over the past 5 years did not happen by chance. I think it truly demonstrates the success of our derivatives business. It's not just in equities, but across all asset classes. By constantly innovating on the structuring, research, and platforms, we customize our products to meet our client needs and risk appetites. These are what sets us apart.
Stefan, it has been a very challenging year. How are you helping clients during the COVID-19 pandemic?
Indeed, it is definitely an unprecedented year. Amid the COVID-19 pandemic, we have responded quickly to market movements and worked closely with our clients to come up with innovative and defensive strategies. First of all, through robust trading risk management, we continue to support our clients. Our funding product volume was multiple folds, while equity derivative trading volume nearly doubled year on year, Secondly, equity valuation were already toppish in 2019. Back then, we had already started working with clients on smart hedging solutions. For instance, quantitative investment strategies were used to construct equity tail hedge financed by carry strategy across different asset classes. When crisis struck, we quickly adapted these strategies.
Thanks, Stefan. Min, Credit Suisse often refers to itself as one bank. How did this play a role in your win?
Credit Suisse is in a unique position in that we can leverage our institutional expertise to deliver solutions to our strong private bank. This made us derivatives market leader for both institutional and private banking clients. For example, in markets, we draw on institutional level portfolio construction techniques and partnering with our CIO office or external managers to offer multi-asset investment strategies to clients. These have been very popular, not just with the institutional investors, but with the private banking clients and family offices too.
Thank you, Min. Stefan, every APAC market is different from the next. How do you set yourselves apart in local markets?
Well, APAC is truly a diverse region. From Australian super to Thailand pensions or Singapore funds, we have been able to adapt solutions to fit local requirements. We provide market access, for instance, to China A-shares, Sharia solutions, or alternative risk premia, all of which require keeping close to our clients and recognizing the needs of our APAC clients are different to the US or EMEA.
Thanks, Stefan. Min, how does Credit Suisse ensure you're always ahead of the game?
Yeah, as a bank, we have continued to invest in innovation, talent, and technology. For example, earlier this year, we set up a brand new team called APAC Dedicated Quantitative and Systematic Strategy Team, which utilize techniques like machine learning and natural language processing to find new alphas. We also continue to enhance our flagship platform called Quantum by adding new features and functionalities. This platform allows clients to actively manage their strategies easily. And also, another strong platform called Spirit enables clients to price structured products and execute trade quickly, which has been a huge success with our distributors.
Thanks, Min. Stefan, how do you adapt your equity derivative solutions for clients across the spectrum, including both institutional and private banking?
Well, asset managers may come to us for portfolio overlay, customized index, or yield enhancement note. We have also built up a risk recycling capability for a structured product franchise, which enable us to offer exclusive opportunities that appeal to a number of client segments across the region.
Thank you, Stefan and Min. And once again, congratulations on winning this year's Equity Derivatives House of the Year award. I am delighted to introduce now Francois Monet, Head of Private Banking for North Asia, and Benjamin Cavalli, Head of Private Banking for South Asia, for this year's winner of the Private Bank of the Year award, Credit Suisse. Firstly, Francois, what does Credit Suisse bring to the table as a provider of private banking solutions? And what is the innovation that makes you a pioneer this year?
Quite a few things, but if I want to summarize it, Marcel, I would say fundamentally client centricity and holistic services. And it all starts with the agility to take decisions in Asia by Asian management on Asian clients. And that's the organization we have. One roof, one boss, one set of clients, and the full range of services to back it. Second, I talked about holistic services. We believe that wealth in Asia is entrepreneurial, and therefore we need to address the needs both the corporate wealth as well as the private wealth. And to do so, you need to work hand in hand with your investment bank. Here in Asia, Credit Suisse has one P&L, one profit and loss statement. That's just the extent of the collaboration. And finally, it's all about execution and leadership in execution. A disciplined positioning on the entrepreneur and a delivery of the services days in and days out with a strong brand, great talents, and of course, the commitment to this region for the long term.
What is the innovation that makes you a pioneer this year?
Well, I could talk about the fact that we expanded our CS chat conversation with the clients, and we had added a lot of features to the digital private banking platform of Credit Suisse. But what is really pioneering this year is the fact that we instantaneously turn ourselves into a remote working organization, doing client engagement to the best of our capacity in less than 2 weeks. And the result has been phenomenal. We reached out 30,000 attendees through more than 100 webinars, podcasts, and seminars on the webs. This client engagement we're very proud of.
Francois, please share with me more about Credit Suisse's winning formula.
The recipes for success. I would love to talk about people actually attracting talents because that's the industry we are in. But I would like to emphasize something we're very, very committed to, which is to go onshore. And you may already know that we have a diversified footprint in this region, the most diversified, being in Japan, Australia, Hong Kong, Singapore, Thailand. But we have a commitment to make a big difference going forward in India and especially in China. And you know, wealth is domestic. So that's the place to be, local and global.
Thank you, Francois, and congratulations again on winning the award.
Marcel, we are going to stay very humble. Humility is about servicing client days in and days out to the best of our capability. Thank you for the award, and we look forward to see you again next year.
Thanks, Francois. Benjamin, could you please share with us more about Credit Suisse's winning formula?
Sure. First and foremost, thank you for the award. We are deeply honored and proud that you recognize and acknowledge us as the Private Bank of the Year for the second time consecutively. This accolade is a testament to our winning formula, rich history globally, and where we are the one and only bank with a divisional setup with a successful integrated banking model in Asia, and our unique and unparalleled connectivity and collaboration with our partners in investment banking, but also global trading solutions and asset management really allows us to bring one-of-a-kind and bespoke holistic solutions to our clients. As a global bank, we have a diverse footprint with multi-booking platform capabilities, and our private banking business has proven to be resilient, and we continue to grow despite all the challenges and headwinds brought on by the pandemic. This demonstrates the strength of our diversity of the franchise and people as well across the region. We are committed to put clients first, where our bankers have an unwavering focus on helping our clients achieve their goals. So we are proud to say that we have the best platform, people, as well as solutions.
Thank you, Benjamin. How important is private banking in Asia, particularly for emerging markets?
Well, private banking is definitely here to stay in Asia. Zooming into the recently published Oliver Wyman Wealth Pools 2020 report, the top key theme that will be reshaping the Asian wealth management industry is clearly onshore wealth. Asia will drive wealth growth across the next few years. And at Credit Suisse, we saw that trend actually very early, and we're one of the first private bank in the region with a well-defined onshore wealth management strategy. As Asian economies also continue to grow, our entrepreneurs are building and expanding their businesses and wealth in their local and home markets, serving their rapidly expanding middle-class consumers, and we are already there for them. Today, I dare say we have the most diversified onshore and offshore footprint in the industry. And for us, really, it's all about access, it's connectivity, it's proximity, and getting closer to our clients. As clients in these markets continue to become more sophisticated in their private banking needs, we bring very compelling international services and offerings that are very often unmatched in the local industry.
Thank you, Francois and Benjamin. And once again, congratulations on winning this year's Private Bank of the Year award. I'm excited to be joined here today with the winner of this year's Interest Rate Derivatives House of the Year winner, Goldman Sachs. Joining me is Amatsu-san, Managing Director, Co-Head of APAC FIC Franchise, George Van Wuren, Executive Director, Macro Structuring, and Cedric Potvin, Managing Director, APAC Head of FIC Structuring. Amatsu-san, what does Goldman Sachs bring to the table as a winner of this year's Interest Rates Derivatives House of the Year winner? What is the innovation that makes you a pioneer?
Sure. Goldman Sachs has been a market-leading position in offering clients in-depth analysis and insights under the current very challenging regulatory and market environment. We also provide a broad range of products and solutions. For example, in Japan, asset liability management solutions and analysis, also LIBOR fallback analysis. In AEJ, significant expansion of emerging market rates business by providing thematic ideas, teaching sessions, and also we are in the front group of providing e-access to new Asia interest rate swaps market.
Thank you, Amatsu-san. George, what are the biggest challenges your clients have had to overcome this year?
Hi, thank you. So I would say there are quite a 3 to 4. I would say the first one is lower rates and the impact, especially for the life industry, and now real money clients who have to rethink the whole idea of the balanced portfolio between equities and bonds, where we're looking to solutions such as alternative duration. Secondly, the great uncertainty, of course, caused by COVID-19 and especially the access to market liquidity in this new working environment. The third is the geopolitical tension, especially focused as China and US, which our clients are asking us on a daily basis. And fourth, especially with respect to interest rate derivatives, is the LIBOR transition, which will have an impact on almost every client, going from corporates to hedge funds who are using any form of interest rate derivatives.
Thank you, George. Cedric, what are some of the main themes shaping the Asian interest derivative rates markets this year?
Hello. We see 3 themes shaping the interest rate for interest rate derivative appetite. The first one is the search for yield through a structured product, moving to more cross-asset products rather than just pure interest rates. We see also a lot of demand for reinvestment as rates have rallied recently. That's the first one. The second theme is significant demand for ILM solutions to basically bridge the ILM gap that insurance companies have, but also pension funds and corporates looking to manage our interest rate exposure, and the education around the change in LIBOR transition.
How important are interest rate derivatives for investors, particularly in the emerging markets?
So, I mean, so Asia has aging demographic as most of the rest of the world, especially if you look at countries like Korea, Taiwan, and Japan. So the need for long-dated fixed income investment has been significant, and And I think it's setting the trend for other markets to follow. So if you look at Taiwan as an example, over 60% of their assets is in fixed income in US dollar. So their appetite for reinvestment is going to be significant. And I think this is going to be a key theme. What are going to be the products they would be able to buy to generate returns, fixed income returns, that is. So I think that's the first one. And the second one is, as interest rates are expected to remain very low, what are the products which can generate enhancement outside of just interest rate? And I think we're moving to more cross-asset exposures through either market access to domestic markets or exposure to credit and rates bundled together.
Once again, thank you for joining us, and congratulations on winning this year's Interest Rates Derivatives House of the Year. I'm excited to be here this afternoon with the winner of this year's Asia Structured Products House of the Year, Goldman Sachs. Joining me is Cedric Potvin, Managing Director, APAC Head of Fixed Structuring, Ken Choi, Managing Director, APAC Head of Rate Structuring, and Pratik Turakia, Executive Director, Securitized Structuring. Cedric, what does Goldman Sachs bring to the table as the winner of this year's Asia Risk Structured Products House of the Year?
Thank you, Marcel. So first of all, I think we are delighted to receive the award on behalf of the team and Goldman Sachs in Asia. To answer your question, I think one of the key focus for GS over the last few years has been the development of a scalable and cost-efficient platform for structured products to meet growing demand from both institutional and retail clients in the product. And what we have done is really standardize and streamline the process to be able to deliver those products. And I would name a few things where I think efficiency has been gained. First is pricing tools to be very quick in giving indication. Second one is electronic execution to facilitate the trade. And then secondly, developing product deliveries through different platform or different formats, one of which is SPV repack, which we have really spent a lot of time to streamline and make cost efficient, especially when you talk of private banks. So those are I would say, the main progress we have made. And these are multi-year endeavor to get to a place where we have an efficient platform. And this is something which is still work in progress. And the other thing I would highlight is that given the low interest rate environment, the team has also worked to have an offer which is cross-asset across FX, rates, credit. Specifically in credit and EM, we have developed an increased product offering.
What have been some of the main themes shaping the Asian structured products landscape this year?
So thanks. So I think two points here. I think the first one is, and I mentioned it a little bit before, has been the automation of financial markets. So being able to deliver more trades with no operational risk is critical. When you do structured products, this payoff can be complex, documentation is bespoke, the booking can be bespoke. So automation across pricing and documentation has been critical. And while doing that, you still need to innovate. So innovation and being able to offer cross-asset product, especially credit-linked hybrids, has been extremely popular. So the team has spent time, again, being able to deliver innovation in that space.
Thanks, Cedric. Ken, how important are structured products for investors in Asia, particularly in emerging markets?
Sure. Structured product has been key yield enhancement tool for investors in Asia. Over the year, we have seen steady growth of structured products in Asia with both institutional and high net worth investors. Especially under the current low interest rate environment, we see structured product to be more important than ever because it can provide tailor-made solution to achieve investor yield target while being within the risk and the asset classes they are comfortable with. At Goldman, we are very committed to providing a wide range of structured products to satisfy each of our client needs by focusing on payoff innovations and continued investment in automation and platform. Thank you.
Thanks, Ken. Pratik, to what extent is the innovation demonstrated by Goldman Sachs solutions, and how does that matter?
Sure. Firstly, thank you very much for this opportunity. This is well appreciated. At Goldman's, we can comfortably say that we have a very well established one global platform solutions that we deliver to our client. And this spans across all wrappers, namely notes, OTCs, and fund solutions. And this goes across all regions as well. What it allows us to do is to focus all our time and effort in ensuring that we have the best solution put forth. And at the same time, it allows us to gain a lot of efficiency and cost. Secondly, at Goldman's is almost a habit about thinking how to use technology in whatever solutions we want to implement. Maybe as an example, we have in the recent past put a lot of focus on ensuring that the clients can have a very fast price discovery process, which enables to kind of give them multiple pricing in a single day, and at the same time make the platform low touch. So namely technology solutions like parallel computing, machine learning, we have implemented this, and this is actually a workable solutions in the financial industry that is helping us to deliver clients the solutions quicker and faster. And also what is important is that we have been very smart about how we deliver solutions without or with minimal impact in this ever-changing regulatory environment. So, we being a US bank, regulations, right, from margining rules to Volcker, etc., have been very prominent in the last couple of years, and it is very important to understand how we can continue running the business and continuing enabling the business, but ensuring that we are all times compliant. So, if I were to sum up, one platform solution, use of technology, and which will continue, and lastly, how to kind of keep the business going in this regulatory environment or regulatory challenging environment is what has been the focus of innovation at Goldman's. Thank you.
Thank you, Cedric, Ken, and Pratik. And once again, congratulations on winning this year's Structured Products House of the Year Award. I am honored today to be joined by the Head of Capital Markets and Chief Investment Officer, Mr. C.K. Chai from Ping An Asset Management, the winner of this year's Asset Manager of the Year Award. CK, what does Ping An Asset Management bring to the table as a provider of investment solutions?
Thank you, Marcel. First of all, I'm very honored to accept this award on behalf of Ping An Asset Management Hong Kong. I want to thank Asia Risk for organizing this event. I want to thank all the people on our team for their professionalism, their hard work, and their dedication. I also want to thank all clients for their support and their trust. Without them, this would not be possible. Now, let me answer the question you just asked. We are the offshore investment platform for the Ping An Group. We manage money internally for our insurance business. We also manage money globally for our third-party clients. We're unique in a way that we are a multi-asset class manager, connecting China and the rest of the world. We help our clients in China to invest globally, and we also help our global clients to invest in China. In terms of our investment capability, we're best known for our quantitative strategies, our China fixed income expertise, and also our alternative asset capability from private equity, private debt, all the way to real estate and infrastructure.
Thanks, TK. In terms of innovation, what is the plan this year to have won this award?
Ping An Group is the largest insurance company in the world. It is also one of the most innovative and technology-driven financial conglomerates. We are a pioneer in developing and utilizing AI technologies across many aspects of our core business. So, as the offshore investment platform, it's very natural for us to adopt the same approach to have a technology-focused culture. I call this culture SQS, scientific, quantitative, and systematic. We have built a cutting-edge AI quantitative investment platform using neural networks and machine learning, particularly deep learning. Another thing that we are very proud of is our involvement in green investments. We are the first asset manager in the world to launch a China Green Bond Fund. Climate change is the biggest challenge for all of us. We want to be part of the solution to make this world better for our children. Ping An Group is the first China asset owner to sign the United Nations Principles for Responsible Investment. Ping An Asset Management Hong Kong is the first Asian institutional investor and Chinese asset manager to partner with Climate Bonds Initiative to use the most sophisticated green taxonomy in China. Having said all this, what really sets us apart is we find meaning in solving our clients' problems.
Thank you, CK, and congratulations once again. I'm excited to be here today with the winner of this year's Derivatives House of the Year Asia ex-Japan, UBS. Joining me is Fabien Philippou, Head of Index Fund Derivatives Trading for Asia, Joe Evans, Director of Macro Sales, and Savio Joseph, Head of Asia Institutional Derivative Sales. How important are UBS's derivative solutions for investors in Asia, particularly in emerging markets?
So innovation is very, very important to us here. And at UBS, we drive innovation through technology. In FX, for example, together with our market-leading Neo platform, as well as T-Pricer, we are able to price vanillas and first and second generation exotics electronically and quickly. There's been constant investment in our hardware and the platform, and this means that clients can get prices with a faster response time, with a seamless user experience, and on a wider range of products. Besides the service level innovation, we are also able to provide product innovation through T-Pricer. This product allows us to backtest ideas, use our analytics for idea generation, and also put in place alerts so that we can proactively advise clients when trades are ripe for restructuring.
Thank you, Joe. Fabien, what does UBS bring to the table as the winner of this year's Derivatives House of the Year Asia ex-Japan? And what is the innovation that makes you a pioneer?
Thanks. So this award is a recognition of the depth of resources and collaboration that UBS deployed to provide innovative solutions across Asia Pacific. This strong collaboration between UBS Investment Bank and its wealth management division generated tremendous value for our clients. This year, the innovation was driven by twin engines of client solutions and technological enhancements. A good example of this is the UBS China Fund Outperformance, which we raised almost $1 billion of. Its success was underpinned by both global and in-country China expertise and inventory management of our division together provided superior returns for our clients. On the technology side, we introduced machine learning to improve quoting accuracy and speed for retail clients. Our state-of-the-art warrants market-making platform allows us to maintain tight and liquid markets even during periods of extreme volatility, resulting in enhanced customer experience and increased market share. And finally, the quoting innovation that we made on the FX business, including a new pricing engine, improved the client experience and allowed the desk to become a market leader at the time of tumultuous events in March.
Savio, what else is on the horizon for the firm's derivative solutions? What are your plans, especially during these turbulent times?
Thank you, Marcel. So derivatives and solutions is the single largest component of UBS's combined global markets initiative in 2020. The firm continues to invest in its people, platform, and technology as it expands into new markets and develops its product suite. Significant progress has already been made in providing cross-asset derivative solutions to global clients seeking to invest into Asia and for Asia domicile clients who seek to invest globally. The breadth of UBS's global franchise, our deep local expertise, and a flexible but robust approach to business continuity held us in good stead, notwithstanding the market turbulence at the end of first quarter, and making UBS the preferred partner of choice for our clients.
Thank you, Fabian, Joe, and Savio, and congratulations once again on winning this year's Derivatives House of the Year Asia ex Japan.